If you lost money in crypto in 2024, the IRS actually owes you money. Most people don't know this, but you can legally turn your losses into thousands of dollars in tax refunds. In fact, if you sold crypto at a loss, you could deduct up to $3,000 from your taxable income this year and carry forward unlimited losses into future years. But here's the problem. 73% of crypto investors don't report their losses correctly. And when you don't claim them, the IRS keeps your money. So in the next 10 minutes, I'm going to show you exactly how to claim crypto losses, avoid audit triggers, and turn 2024's worst investments into 2025's best tax move. Let's break it down. Welcome back to Tax and Tech Explained, where we help freelancers, digital nomads, and crypto entrepreneurs stay legal, stay smart, and keep more of what they earn. I'm here to decode the taxes behind AI, crypto, and remote work, because the rules are changing fast, and the IRS doesn't send reminders. Today, we're talking about crypto capital losses, one of the most underused tax strategies in 2025. If you sold Bitcoin, Ethereum, NFTs, or any other digital asset for less than you paid, you're sitting on a deduction. And by the end of this video, you'll know exactly how to file it, what forms to use, and how to maximize your refund. Let's get into it. Here's why this matters more than ever in 2025. The IRS now has direct access to your crypto transaction data. In 2024, Coinbase, Kraken, Binance US, and every major exchange started sending Form 1099-DA to the IRS, reporting all your crypto sales, including losses. That means the IRS knows you sold crypto. They know when. They know how much. And if you don't report it on your tax return, they assume you made a profit, and they'll send you a bill. But here's the thing. Losses are deductible. And they're one of the few silver linings in a down market. If you bought Bitcoin at $60,000 and sold at $40,000, that's a $20,000 capital loss. And you can use that loss to reduce your tax bill, offset gains from other investments, or even lower your W-2 income. This isn't a loophole. It's tax law. And in 2025, with the IRS auditing crypto more aggressively than ever, reporting losses correctly isn't optional. It's essential. So let's talk about how it works. A capital loss happens when you sell an asset for less than you paid for it. In crypto, every time you sell, swap, or spend digital currency, it's a taxable event. Let's say you bought one Ethereum for $3,000 in January. You sold it in October for $2,000. That's a $1,000 capital loss. You report that loss on IRS Form 8949 and Schedule D, the same forms used for stocks. And here's what makes it powerful. You can use that $1,000 loss to offset other gains. If you made $5,000 selling Tesla stock, but lost $1,000 on Ethereum, your taxable gain drops to $4,000. You just reduced your tax bill. But what if your losses are bigger than your gains? This is where the $3,000 rule kicks in. If your total capital losses exceed your capital gains, you can deduct up to $3,000 per year from your ordinary income, like your freelance income, W-2 salary, or side hustle revenue. Let's say you made $60,000 freelancing. You lost $8,000 in crypto. You had no other investment gains. You can deduct $3,000 from your $60,000 income, reducing your taxable income to $57,000. That saves you around $700 to $1,100 depending on your tax bracket. And the remaining $5,000? You carry it forward to next year and keep using it until it's gone. This is called a capital loss carryforward, and it never expires. You can use it for the next 10, 20, even 50 years if needed. Here's the step-by-step process. Step 1. Download your transaction history from every exchange you used, Coinbase, Kraken, Binance, MetaMask, whatever. Step 2. Use crypto tax software like CoinTracker, Coinly, or TokenTax to calculate your gains and losses. These tools auto-generate Form 8949 for you. Step 3. Transfer that data to Schedule D on your tax return. Most tax software like TurboTax or FreeTax USA integrates directly. Step 4. File your return. If your losses exceed gains, the software will automatically apply the $3,000 deduction and carry forward the rest. You don't need an accountant for this, but if you traded thousands of times or used DeFi protocols, it's worth hiring a crypto CPA. Because one mistake, like forgetting to report a sale, can trigger an audit. Now, here's a question everyone asks. What about the wash sale rule? In traditional investing, if you sell a stock at a loss and buy it back within 30 days, the IRS disallows the deduction. That's called a wash sale. But here's the good news. As of 2025, the wash sale rule does not apply to cryptocurrency. That means you can sell Bitcoin at a loss, claim the deduction, and buy it back the same day, perfectly legal. This is called tax loss harvesting, and it's a huge advantage crypto has over stocks. But there's a catch. Congress has proposed adding crypto to the wash sale rule starting in 2026. It hasn't passed yet, but it's coming. So if you're planning to harvest losses, do it now, while the window is still open. Let's lock in 5 legal facts you need to know in 2025. Fact 1. The IRS classifies crypto as property, not currency. That means every sale is a capital event, just like selling a house or stock. Fact 2. Even if you didn't receive a 1099 form, you're still required to report all crypto transactions. The IRS asks directly on Form 1040, did you receive, sell, or exchange digital assets? Fact 3. Losses from crypto gambling, rug pulls, or scams are not deductible as theft losses anymore, thanks to the 2017 Tax Cuts and Jobs Act. You can only deduct losses from legitimate sales. Fact 4. If you're audited, the IRS will request transaction records going back 3 years, sometimes 6. Keep everything: wallet addresses, timestamps, exchange statements. Fact 5. If you live abroad as a digital nomad, you still owe U.S. taxes on crypto gains and losses, even if you're using the foreign earned income exclusion. Crypto is investment income, not earned income. These are the rules. They're not optional. Alright, here are your 4 actionable takeaways. 1. If you sold crypto at a loss in 2024, report it. Don't leave money on the table. 2. Use the $3,000 deduction to lower your taxable income this year, and carry forward the rest. 3. Harvest losses before 2026, when the wash sale rule might apply to crypto. 4. Keep detailed records. The IRS is watching crypto closer than ever. This isn't about gaming the system. It's about following the law and keeping what's yours. So that's how you turn crypto losses into real tax savings. If you lost money in 2024, you're not just a victim of the market, you're sitting on a legal deduction. And now you know exactly how to claim it. If this video helped you understand the law behind your income, hit that subscribe button, because smart money needs smart rules. Drop a comment if you've claimed crypto losses before, or if you have questions about your specific situation. And if you want a free crypto tax checklist, the link is in the description. Thanks for watching Tax and Tech Explained, and I'll see you in the next one.